Hello everyone, my name is Jyot Sifat Kaur and I am from BCom Financial Services Semester 5. Today I am here to give the seminar based on training. But before that, I would like to extend my heartfelt gratitude to Mrs. Meenu Kohli, head of the department, and Mrs. Beenu Gupta for their invaluable guidance throughout the project. I am also indebted to our principal madam, Dr. Mrs. Ajay Sareen. The project report is based on the topic Income Tax for Individuals and the Related Accounting. The training was taken from I.S. Arora and Company, Chartered Accountants. Brief overview of the income tax. History of income tax. In India, the income tax was introduced by the first time in 1860 by Sir James Wilson in order to meet the losses sustained by the government on account of military mutiny of 1857. In 1886, Separate Income Tax Act was passed and remained enforced up to 1917 with various amendments from time to time. In 1918, a new Income Tax Act was passed and again it was replaced by a new act which was passed in 1922. This act remained enforced for accounting year 1961 to 62 with numerous amendments. The Income Tax Act 1922 had become very complicated due to innumerable amendments, so the Government of India had appointed Direct Taxes Administration Inquiry Committee to suggest measures to minimize the inconvenience to assess and to prevent tax evasion. In consultation with Ministry of Law, finally the Income Tax Act 1961 was passed. The Income Tax Act 1961 has been brought into force with effect from April 1, 1962. It applies to whole of the India, including Jammu and Kashmir. Since 1962, several amendments of far-reaching nature had been made in Income Tax Act by Finance Act every year. Various amendments acts were taken in 1984, 87, 89, 1991, 1992, 93, which were mostly based on recommendation of July Committee report. Basis and procedure of charging income tax. The total income is computed on the basis of residential status of the assessee. The income is classified into various heads. Income under the head salary, section 15. Income under the head house property, charging section 22. Profits and gains from business or profession, charging section 28, capital gains, charging section 45, and income under the head other sources, charging section 56. For computing the total income of an assessee and tax payable by him, following procedure is followed. Classify the income under each of the above 5 heads and then deduct the income under each head. The deduction permissible under the Act is irrespective of the head of the income. The balance of the amount left under each head of income is its assessable income. Total of the assessable income of each head or the aggregate of all these assessable incomes is called the gross total income. From the gross total income thus arrived at, deduct the deductions permissible under section 80C to 80U of the Act for computing the total income. The balance left after subtracting the valuable deductions is called the total income. The amount of income tax payable is then calculated on the total income according to rates prescribed by the Finance Act for the relevant assessment year and rates prescribed under different sections of the Act. Computation of tax for accounting year 21 to 22. So, the step 1 is calculation of total income. There are 5 heads of income under which income is classified. These heads are listed below. Income from salary. This includes all the income earned as part of your salary. You can find these details in the Form 16 issued by your employer. Income from house property. If you own a house that you have let out as a rental, the rental income earned from the house property falls under this head. Income from business or profession. For self-employed individuals practicing their own business or profession, the income earned is classified as business income. Income from capital gain. Any profit arising out of the sale of capital asset during the financial year is taxed under this head. Income from other sources. Any other sources that cannot be classified under the mentioned heads above are classified under other sources. Some examples include interest on fixed deposits, dividend earned, and lottery winnings, etc. So, the step 2 for computation of tax for accounting year 21-22 is account for all deductions from your total income. The deductions may include premium paid for ULIPs, tax saving fixed deposits, national saving certificates, investment in NABARD bonds, etc. So, let's start with the practical aspect of my training. Basis for preparation, income tax return. So, this is the specimen of the income tax return I have studied in the practical point of view in the training. The client is a doctor by profession and his name is Dr. Darshan Singh. He practiced his profession in Kartarpur. He submitted his salary certificate from JS Hospitality. He submitted the rent details from rent earned from let out flat. He submitted his gross receipt from his clinic named MS Clinic. Mrs. DS Clinic. He provided his bank statement, saving account in Punjab and Sindh Bank and Union Bank of India. He provided FTR interest certificate from SBI. He provided evidence or details of agriculture income as well as expenses. He provided details of capital gains from shares. He provided details or evidence of sale of his residential plot which was purchased in 2008. He provided tax deduction certificates for bank interest and TDS from dividend. He also provided details or evidence of various tax saving investments and insurance premium. Analyzing various heads of income. The assessee has earned income under the following heads as per the document provided by him. Income under the head salaries, income under the head house property, profits and gains from business and profession, income from capital gains, income under the head other sources. He has earned agriculture income which is to be included in the return for the rate purpose. On the basis of documents provided by the assessee, he is eligible for the following deductions from gross total income. Section 80C, Section 80D, Section 80 TTA. Calculation of income as per law after various deductions and tax liability on the same is being discussed in the following slides. Income from the head salaries under Section 15. Assessee's personal information was punched in the software including his name, father's name, address, PAN, Aadhaar number, etc. Then on the basis of salary certificate submitted, salary income was recorded in the software and standard deduction available. Net salary income was calculated as per extract from the computation. Income from house property. Then on the basis of rental property, details provided, the same were in the software wherein standard deduction at the rate 30% was permitted and balance taxable income under the head was calculated. Profits and gains from business and profession under the Section 28. The assessee opted for return without account books under the Section 44 ADA of the Income Tax Act wherein a professional can declare 50% of the gross receipts as his taxable income from profession and he is not required to maintain account books. The assessee has declared his gross receipts based on OPD register maintained at his clinic. Capital gains under the Section 45. The assessee sold shares of Tata Power Limited listed securities and its details were entered in the software on the basis of supporting documents provided by assessee regarding sale and its respective purchase earlier. The difference of sale and purchase has been shown with the computation as taxable short-term capital gain since the holding period was less than 12 months. Assessee sold his residential plot which he bought in 2008. Since holding period is more than 24 months, hence it's a long-term capital gain. Difference between sale and purchase after application of cost inflation index is long-term capital gain which is subject to tax at flat rate of 20% plus cess. Income from other sources under section 56. The assessee earned interest from two saving accounts, FDR interest from FDR held with SBI and dividend from holding of shares of Infosys Limited. Since the dividend was more than 5,000, hence tax has been deducted by Infosys Limited. Likewise, FDR interest from SBI is more than Rs 40,000, so the bank has deducted TDS on interest income of the assessee. Gross total income under section 14 of the Income Tax Act 1961. Resultant taxable income has computed under various heads after reducing standard deduction available has been sum total as gross total income. This gross total income includes long-term capital gain subject to tax at special rate of 20% and short-term capital gain listed securities at special rate of 15%. Agricultural income under section 2 subsection 1a. Also, the agriculture income and agriculture expenses has been entered in the software and some have been reflected in software along with the figure of gross total income. Admissible deductions. Deduction under ATC, deduction ATD, deduction ATTTA have been calculated in software as per details of computation, and total income of these deductions has been reduced from the figure of gross total income to arrive at total income. Calculation of tax. As discussed above in various paragraphs, tax calculation has been done in software applying slab rates of tax as well as special rates of tax of short-term capital gain and long-term capital gain. The assessee has been following old regime of the tax rate since he has made investment for availing deductions. Again, income's effect has been shown in tax calculation by calculating tax on agriculture income plus basic exemption and reducing the figure derived at total tax liability as calculated above. The resultant tax liability is the actual liability of assessee for the year, which has further been reduced by the TDS and advance tax paid. The balance figure payable has been paid by the assessee as self-assessment tax under section 140A of the Income Tax Act, and thus the computation of income is complete. Conclusion. Going through the slides of presentation, one is able to very well understand the basics of calculation of income tax where the assessee has multiple sources of income. Not all the assessees practically have income from all the sources, and the present taken up assessee is an exception since he is having variety of incomes covering all the heads of income. The facts may change from assessee to assessee, person to person. Number of items under various heads may change, but the procedure to calculate tax and file the income tax return remains the same. In nutshell, the presentation above carries all the integrities of calculation of income tax in case of an individual. Following this, we may calculate tax and prepare return of income of an individual replacing these facts and sources of income. Thank you.